Stocks rallied again today with a nice opening gap here this morning. Was that enough? Was that the move we're looking for that will spark the intermediate rally? There are signs, some bullish signs creeping in. They're looking more and more positive. So I'm going to break those down and see, if we should expect now this intermediate breakout here this week or not. So I'm going to let you know kind of what I'm seeing and what I expect based off of those technical signs. We're also going to talk about what's driving this risk appetite and potential breakout today, and why and whether or not that confirms or denies this semi breakout move. And then finally today we're going to take a look at a sector that's benefited from the rally, but may not have enough juice to get going to the upside based on its intermarket relationships, and we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, September the 4th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 first with the market forecast indicator. The intermediate line continues to rise now, peaking above these last two intermediate peaks, even if we haven't necessarily crossed through these highs yet. We are closing at the high of the day today, retesting the high from last Friday, as well as the high from August the 22nd, and the high from August the 13th, and the high from August the 8th. So, we've touched this area multiple times. That's why there's some resistance here. But in this case, the momentum line, the only other time, August the 8th, is the only other time the momentum line was this high. The near-term line, you notice, is not high, but at least it didn't drop below 50 on this little pullback. So this is actually still, 1, 2, 3, 4. This is the fifth day for the near-term line being up above the 50th percentile. So you have some kind of increasingly bullish signs. Yes, market sentiment's declining. It does that when you're in an intermediate pullback. Here's an intermediate pullback. It does decline. Of course, if you stay too bearish for too long, then it drops below 50, and that's more of your market sentiment pullbacks. And usually that means that we drop through the Fibonacci retracement zone on the intermediate pullback, and we've gone further down. You can see we still are holding, and we're actually a little bit above that retracement zone now. We're still in the bigger retracement zone. You see here, let's edit the properties, and let's bring on the 23% as well, and we'll make that one a dotted line like its counterpart at the low end. So this dotted area is the bigger retracement zone that we fall into. That's when you start to get more of an intermediate pullback, when you start to get into the retracement zone. And of course, here, let's just get rid of the 50%. The 50% is kind of a halfway mark. You can kind of see, okay, there's your retracement zone. Well, here, let's make it stand out a little bit more with like a purple color or something like that. All right, so there's your bigger retracement zone in purple. Well, that doesn't really stand out, does it? There, that kind of makes it stand out a little bit more. So there's the kind of the shorter retracement zone, and then of course the bigger one of these blue dotted lines. So we're still inside of that, and getting up above 29.55 will really get us going to the upside again and start us up. And until then, especially considering that we're just kind of flirting with the top end of this, as we've done a couple of other times, until we see that support break, resistance break, we expect resistance to hold. Until it doesn't. So good signs, like we are leaning towards the upside here, progressively leading towards the upside. Now you'll notice here because it's still below 50, we have light green shading. We don't have the dark green shading yet, and we closed up above the moving average, which means tomorrow, it'd be nice if this was Friday. Tomorrow, that line will be yellow. So yellow lines and light green shading is usually kind of a bearish combination, unless it leads to trend reversal, right? Because obviously all trend reversals start with bearish patterns first. But until then, we have that's a pretty bearish pattern. It'll be, like I said, because we're closing above a falling moving average, it'll be a yellow line. And because the intermediate line's rising, but below 50, it'll be light green shading. that can be bearish. It's not bullish until we get the dark green shading and the green line, right? That's your bullish combination. That's when you know, okay, we're set, we're entrenched. Of course, nothing's 100%, but that's your combination, the pattern that you look for to look for bullish trades that will be bullish for a while. So, and of course, again, we teach that in technical analysis, a scan for those. If you look at the Dow Jones Industrial Average, you can see, whoops, here we go, Dow Jones Industrial Average, you'll see very similar pattern. Again, we just had it a couple days ago right there on the Dow. Same thing, yellow line, dark green shading, not breaking out yet at least. Same thing with the NASDAQ. It's even, usually this is the one that's been leading, and that's not even close to breaking above those old highs. And actually, let's see, the moving average 79.84.14, and we close at 79.76. So actually, that's still going to be red. We don't even have a yellow line. We won't have a yellow line tomorrow on that. It will still be red because we closed below it. And then finally, the Russell's not even close to crossing above it either. So another kind of sign here that not to put a lot of stock into what may look like a breakout today, and a pretty decent sign that that resistance may actually have a better shot at holding than it does breaking. Based on what we're seeing. I mean, look, the intermediate posture is bullish, weak, about as weakly bullish as you could possibly get on the Russell, and we are still well below the moving average. So just getting light green and not even close to a yellow line. So again, it kind of shows just how bearish, it can be there. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video. That will notify you. Click that bell that's by that subscribe button. That will notify you when these videos are posted. Hit the thumbs up icon down below the video too. That lets us know that you got something out of the video again, but more importantly, it lets us know you want us to do the video again tomorrow. So that's the only way we get feedback. We don't do surveys. Our feedback, our survey satisfaction that we look at is how many thumbs up we see down there. So if you like these videos, you want us to do it again tomorrow, you can click right now while you're watching. Also, while you're down there, comment. What did you get out of the video today? Anything stand out? Anything helpful that can help you going forward? That can help anybody else that's coming to the Market Outlook for the first time. We get so many first-time viewers day after day. Let them know why they should check out the video. Join our daily Market Outlook email list. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe. Follow me on Twitter for more content in between these videos from day to day. And join our Market Outlook community that we've created on Facebook. Also, if you're watching on our blog, a few things to point out. Here's our upcoming schedule. Brandon has his Q&A session tomorrow. Always very, very informative. So make sure you check that out, as well as my upcoming classes, my end-of-week classes, including the technical analysis class, which is part of your monthly trial. So if you're interested in us, you want to check us out, you can get a 30-day trial to our monthly plus subscription. It also includes access to our Market Outlook live videos that we post on a daily basis. So if you click this image right here, it takes you to our Market Outlook live page where you can watch the trade review, our Market Outlook trade reviews. We go back and look at old trades. We manage them all the way to their close, and then we put on today's trade before the market closes. And we also have old archives as well. This window here is for chatting, so a lot of our clients chat with each other during the video, so you can be able to chat there. But again, that link is there. You can also see it under trading rooms here. If you mouse over trading rooms and click on Market Outlook Live. If you want more information on that subscription plan, just click on this link. That will take you there. We also invite you to engage with us on social media. That ensures that Twitter and Facebook put our content at the top of your timelines, because that's not always the case. So to kind of make sure that that happens, just engage. Click that like button, that heart right there. It opens up a new window. You can like today's Market Outlook tweet, very easy. Click that image, takes you to your Facebook page. You can like tonight's Market Outlook Facebook post. Again, the more you engage, like, retweet, comment, the more likely they are to make sure you see our content, even if you haven't been on Twitter all day. And when you come back on, they'll put it at the top of your timeline. All right, back to the charts, and you can see, we're getting a nice, good bullish, a little bit of a lower shadow, smidgen of a lower shadow this week. I actually think we'll end up getting more. I think we'll have another transition week, but But as of right now, it's looking like a pretty good bullish candle. Again, breaking through these highs are what's going to be really the differentiator. We are at the high here, so we got to break through those highs. That will really get us going, as you can see, getting through the high of the transition week, getting through the high of the, closing above the high of the transition week is what really gets the trend started. You can see lots of examples of that. And so, the high of the transition week is 29.40.43. So closing above that and probably not by a smidgen, right? If we can close significantly above that, that will really get this long-term PPO, this long-term momentum rising again. Let's take a look at the 3 green arrow chart. We got 3 green arrows, 1, 2, 3 with the close. We didn't get it on Thursday last week, but we did get it today. Again, just like 3 red arrows can be a buy signal on the bullish trend, 3 green arrows over here, you can see we had really broke through over there. 3 green arrows can be a sell signal on a bullish trend. Here is another example. It took a couple of days, but it was another example of a 3 green arrow signal on the bearish trend. And we obviously have been on the bearish trend. And we'll see if that 3 green arrows plays out or not. That resistance holds, then that's the kind of pattern you can expect. This kind of bounce, but to the downside. And if the resistance doesn't hold, then we'll get our trend reversal. We'll get the green shading, which we have with the 3 green arrows, but then we'll get the green line, which means we're trading above a rising moving average, which obviously is not the case yet. Looking at the 2-line versions, you can see, we are up above the 30-day moving average. The MACD, the 8-day is barely crossed up above. So it's kind of like that next stage. So we'll see if that holds. See over here, you can kind of see the same thing. We got a close above it, the 8-day close above the 17, but you didn't get that last stage where both lines crossed above the 30. You kind of did there, a little bit of a false breakout, then you moved around. On this 3 red arrow signal, you almost got the 8 below the 17, but not quite, and then we rallied. And so obviously you didn't get both of them crossing below the 30 like you did here and like you did over here. So, kind of that next stage, and we'll probably take a breakout above this 29.40 area. The next stage would be to get both these lines up above the 30. And now we're entrenched on a new intermediate run that will last 1 to 3 months. Until then, like I said before, expect resistance to hold until it doesn't. All right, now let's take a look at the intraday chart, and you can see, so this is the gap I talked about yesterday in the video that, okay, good chance we can retest this area again. Well, we did it overnight, so we gapped up to the upside. Again, did not have a bump in volume associated with that, and we didn't break through a significant level. So lacking those 2 things, there's a pretty good chance that that's another common gap. Doesn't look so common because it was relatively big, but so was this one, and it got filled, and so was this, and it got filled. It might take a few days, and I don't think necessarily we'll fill this tomorrow. We could, but I think, with the point of control down below us, it actually might take a few days to fill this common gap. But, it's got all the characteristics of a common gap, and they tend to get filled sooner rather than later. So another reason why I'm not buying the hype, so to speak, on this nice bullish run. Had we opened up here, now again, that's a pretty decent move. So it's another reason why I was very skeptical. I would have liked us to be closer to, if we hadn't had that gap right there and we closed right here, I'd feel really good about a gap through with a bump in volume and away we go. But now because we moved up so much, that obviously, if we would have gapped up here, that would have been a tremendous gap to the upside, very, very likely to fill in. We didn't get that. Regardless, we are closing up to the resistance, not through it. And again, you can kind of get an idea. In fact, if I look at you can see the volume, how it tapered off there tremendously. If I take a look at today's volume, it was less than what we had yesterday. So again, another sign that we're not breaking through a level, right? It's, we don't need a spike, but we do need a bump in volume to get through a level where, a barrier. Where there's a lot of buyers and sellers, and right now that wasn't necessarily the case. 46 million shares. Keep in mind the gap. So we close at 290.74, the low 292.31. So about a 1.5 difference. So you add that to today's range, 1 3/4. So you're looking at about 3 1/4 points. So that's below the average, and the volume is well below the average. That's bringing these numbers down. That's a good sign from a bullish standpoint, because when we are trending higher, these lines will come down. We've got plenty of room to go down because the ATR to price is right around the 1.5 area. So we've got the opportunity for a trend to begin. The question is whether or not it'll begin today, tomorrow, Friday, or if it'll begin a little bit later in the month. And again, barring a breakout here in the next couple of days, the expectation is that we'll probably hold this and fill in this range down here to these lows before that intermediate trend really takes off to the upside. Seeing that these are higher and starting to roll over, we probably won't get a drop like this, kind of a drop here like we had in late December. Probably not going to get that kind of a move. It's probably going to be more this type where we look like we're starting to bounce and then we make another run down and then we take off. That's probably more what we're expecting to see. And don't be surprised, like it did here, that this next run down doesn't get a little bit lowered, maybe down to 280, before things really take off and get going. Because again, when things take off and get going, it'll be because nobody thinks it will, right? That's generally the spot where we hit the low point, and I don't think we really ever hit that spot here where people are just too thinking that this recession is starting right now. All right, let's take a look at the volatility. And you can see it's dropped. It's got a little bit more room to drop. So like I said, I don't think it will be another. I think it will be another day or two before that gap fills from this morning. But you can see, the volatility is moving towards that 90%. Breaking below 90, this trend is off to the races. 1 to 3 month expected intermediate run. Until then, look for support to hold until it doesn't. And there's support at the 95% that we got below today. There's support at the 90% level that we're not below yet. So there might be another bounce of volatility in store for us before we get that intermediate rally started. All right, so we'll take a quick pause here before we look at what's driving the market and just kind of summarize the technical outlook. So we've got signs that things are looking better. We don't have the breakout signs yet. Breakout in terms of that new intermediate run starting, but we're getting closer. We're knocking on the door, which means we're getting less bearish. That doesn't mean that we won't get any bearish moves because there's ups and downs in the market. I'd still expect that we'll get another down, but the next down move won't be so doom and gloomish, right? People won't be running for the hills necessarily. And then that intermediate rally can start because we're getting so close and things are looking better from a technical standpoint. So what do you think? Do you agree with that assessment? Do you disagree? As always, there's a link right there in the top right corner of your screen. Click that link. It opens up a poll. Then vote. Either agree or disagree. If you click disagree, comment down below. What do you see that's different? That would either suggest that you're already on that bullish train, or any pullback we might get will be one of those run for the hills pullbacks. So feel free to share what you're seeing with other market scholars in the comment section below. All right, now let's talk about what's driving the price action here today. And of course, you can see the safety trade is has been so bullish, and it's near its highs. Gold is at its highs. This is a 3-month chart, and long-term bonds are near its 3-month highs. But you can see, look at the volatility in crude oil in orange, how we've gone down, then up, and then down, then up, and then down. So that's driving a lot of the volatility in the stock market. That's why the stock market really can't get going. And today, and you can see on the other end of the spectrum, the international stocks, which have really been lagging behind, they're starting to pick up a little bit too. And whereas small cap stocks aren't really going, and that's another sign that we're just not quite that bullish yet. But we had an interesting chart here. If you take a look at the different asset classes here, let's move it up to just today's. So obviously the VIX was the biggest loser, but look at the dollar was really one of the only other big losers, along with foreign bond prices, which have foreign bonds have been a lot more bullish than U.S. bonds with the negative yields, just over a longer period of time, whereas U.S. has really kind of taken off here in the recent term. But you can see the VIX down, quite a bit. And on the other end of the spectrum, there's your commodity prices, especially international stocks, outpacing their benchmark that has U.S. international mix, U.S. lagging behind, including your small caps. So not a very broad rally there, in fact your mid caps actually outperformed small caps, and small or large, and way outperformed small. And then you can see gold actually rallied today too. And again, that's mainly because of that dollar move. The dollar had a really sharp drop to the downside. That long upper shadow, that shooting star I mentioned yesterday, played out to a downside move. But again, light pink shading, and extreme low on the downs. But we've been getting extremes on the momentum line to the downside, only to bounce back up. And look at the last few extreme lows on the momentum line. That have kind of set the lows for the dollar, including this most recent one right here. So we'll see what this ends up doing, considering that we had, there's the old high point that we had kind of busted through, the old near-term high. We have formed a higher near-term high point, and we'll see if this ends up being where the new near-term low. The last near-term low was a bullish near-term low because it really only took a day to the downside. That's an evening star candlestick pattern. But again, not much of a move to reverse because we haven't been that bullish. We've just barely broken out to get above 99. The question is, and you can see that drop has really helped crude oil rally, but crude oil is not really taken off either. It's got the dark green shading in the market forecast. Its moving average is still going down, so it's going to be yellow, not green, which is the bullish combination you need, as well as the market sentiment line rising above 50 would be the most bullish combination. So when you take all those considerations, all that technical consideration, this isn't a breakout move on crude oil either. We kind of need to get above these highs, get above 57 to really say, okay, we're breaking out. So be wary of big moves that aren't breakout moves, that aren't trend-changing breakout moves, because they end up just being pretty noisy news and can sucker in a lot of people, at the wrong time, thinking that it is a breakout. Of course, the 10-year note's driving a lot of discussion. It's still down. It didn't rally today like you would expect if this were really a risk-on day, right? You would have expected bonds to be down, and bonds are actually up, not up very much, and obviously lagging behind everything else. And you would have also expected high yield here to really outpace investment grade, and it didn't really do that either. So not the most risk on day, not risk off, right? We're not tanking here, but there's a susceptibility to kind of a false breakout type mentality, or in this breakout mentality that can be actually a false one, because we really haven't got the supporting signs here, even from an intermarket relationship, that this intermediate rally and risk appetite starting back up again. Of course, the interest rate discussion brings into the mind what the Fed may do, and of course the Fed's pricing in pretty much 100% rate cut for a cut in September. The question is whether it's going to be a 50 basis point cut, and there's about a 10% chance of that happening. What are we going to get by the end of December? Well, we're 100% chance of getting one cut, about an 89% chance of getting two, which is high probability. It's pretty much the market has priced in two cuts. Now the question is a third. So it looks like we might get that cut in September, maybe skip October, and then move into, because the odds of a second cut in October are only 70%. It's still high probability, but not quite, not above the 80% mark threshold that we look for, whereas December is. So more than likely, we are going to get kind of like this, and you can see there's about a 47% chance of a third rate cut in this year, which means we get one in September, most likely skip October, and then get another one here in December. Remember, these are the meetings where there's always a press conference now. There used to be that the press conferences were only on these quarters as well, September and December. But now these are the only meetings with the forecast. So you not only do you get the rate decision and the press conference, but you also get their forecast going forward. And so we'll keep our eyes on that. And of course, going out to next March, the odds of being down, see, we're at a 10% chance of getting, a 90% 100% chance that we'll get one rate cut, and then a 10% chance that we'd get two. Well, that 10% chance of being on the 175 by next March is a 98% chance it'll be 175. So by next March, you're looking at, really 3 cuts, 3 moves. Again, 1 September, 2 December, looking like the market's expecting another skip in January and potentially one in March. It's not 80%, it's more like 40%, but or closer to 30-40. But still, that's what the market's looking at here going into next year. It's just kind of like one every other type move just to see what the market will do, not necessarily pricing in the need for a consistent flow of rate cuts yet, which obviously would be bearish for the markets. As we saw in the late 90s, getting a few here and there is not a bad thing, and usually has led to, even with an inverted yield curve, has led to a pretty decent rally, and that's something I would expect, considering, again, how overbought the safety trade is, as you saw with bonds and oil being so strongly bought up in the last few months. All right, if we look at how the sectors have been performing over the last 3 months, or even just today, you can see the FANG type stocks, communication services, technology, leading the way higher. Energy bouncing up today, and industrials and materials. So the dollar's sensitive. With the dollar's move to the downside, has helped those sectors push up. On the other end of the spectrum, utilities and real estate really did well. Utilities and healthcare holding back just barely with positive gains, but staples and real estate kind of matching, just slightly lagging behind the broad market as a whole. Financials also kind of struggling. Again, we're not getting that rise in yields as you would expect with the rise in risk appetite today. So, you take a look at now the sector chart here, the 12 grid of these different sectors, and you say, okay, well, the S&P is close to producing dark green shading. It doesn't have the green line yet, but look at real estate, another overbought cluster. Utilities is also looking like it's well up above its moving average. Staples with an overbought cluster. So the safety trade looks overbought. Whether it's bonds, whether it's gold, whether it's the ratio of low volatility to high beta. There's a lot of factors suggesting how overbought the safety trade is. You can see technology is not really going anywhere. Healthcare is still struggling below a falling moving average. Even though it does have a rising, that you see technology does have dark green shading now because it's above 50. So does discretionary. It's above 50, and its moving average is close to turning up. Industrials, all the rest of these are still below 50 despite their rising moving averages. Energy is not even above, it's barely above 20. So weak bullish postures, and then these last 3, financials, materials, and energy, not even above their moving average, along with healthcare. So you can see which sectors are struggling and which ones are kind of leading, and in these cases, which ones are overbought, and you can kind of see what the rotation. If the dollar continues to go down, which I don't expect it to, but if it continues to go down, you'd want to rotate into energy and materials. But considering that they're still looking very bearish, then you would rotate your gains from these non-cyclical areas into other cyclical areas that look more bullish, like discretionary, like technology, and to a degree communication services. You can see, it's not above 50 yet on the market forecast. Here, let me get this up. For some reason, it's not popping up for me. There you go. But its moving average is really close to rising. You can see it's just barely falling down here. So it's probably the closest to rising out of all of these that aren't already, like technology and discretionary. They still got some room to go. So those are the areas. If the dollar does continue to bounce back up, those are your cyclical areas you want to be. If the dollar does break down, then you want to rotate into these energy materials that have been so bearish. The problem is they've been so bearish and they're not showing signs of not being bearish. Not necessarily the best rotation quite yet. So lost in that discussion is the financial sector, right? It's kind of stuck in the middle. It's like energy, barely above 20. It's still below falling moving average. It's kind of getting up to it. So there's still, I mean, without the rising yields, it's not a good sign for the financial sector. So the financial sector is showing us, an opportunity for with this little kind of rally to trade if we are going to get a pullback. To trade a pullback down from its moving average. You can see JP Morgan as an example. It does have earnings right before October expiration, so keep that in mind in terms of risk management. But you see we closed today at 109.87, just a smidgen below the moving average at 109.99. So not going to turn yellow. We do have the light green shading. It's not going to turn yellow, but it's about as close to being yellow as you can be without. So a bearish pattern, like I showed you before on the S&P 500 that we got last Thursday and again today. If you take a look at its Bollinger Bands, you can see why it's kind of struggling in this area, because around 110 there's strong volume resistance. It can break out, and it's in the upper half of this Bollinger Band, so that's a positive development. But it's not breaking out yet, and again, you expect resistance to hold until it doesn't. So that would lead us potentially to a move down towards the 105 area, where its next layer of support would be. If there is any kind of a bump in volatility here in the short term. Again, might not happen tomorrow, might not happen the day after, but like I said, I expect another bump in volatility before that intermediate rally really gets going to the upside, and you can see how that would impact a stock like this, especially without the financial sector really doing very strongly and yields really not taking off quite yet. In fact, a lot of times when yields have made such a bearish move like they have in a short amount of time, it generally leads to a divergence where you get a good bounce and then maybe another lower low point. So I'm not necessarily bullish on yields quite yet, though we are extreme and there is opportunity for a bounce at some point in time. So you can, if I take a look at the DMI for JP Morgan as well, its positive line, its positive line is almost, it got up 225, didn't get through it. That's your bullish signal, as when it gets through 25. But the other half of that bullish signal is the orange line getting below 20, and that's not, we haven't had that yet either. In fact, it's not even below 25. So again, another sign that I expect this to be more bearish than bullish. If you take a look at its long-term charts here, the long-term moving averages, it's kind of stuck. It's stuck within falling 50-day moving average that's going to hold it as resistance, and this 200-day moving average that we've been floating up and down against. A lot of times that kind of a pattern can lead to more bearishness before we finally get a low point, as we saw last December after some sideways action, some flirting ups and downs around that 200-day moving average. So a pattern like that would set us up for a potential bearish trade heading into its October earnings announcement. So if you take a look at the trade here, you can see that we've set up a short position at 105 and long at 110. If I were to analyze that trade, here, let's get rid of this trade here. You can see the reward here is the risk is a $500 risk, and if you're using $1,000 as a regular risk, which is what I do in my classes, tonight I'm going to give you an idea of risk management. Whatever your regular risk number is, and that number is how much you're willing to lose on a good high probability trade at a worst case scenario. So whatever that number is, in this case we say $1,000. Worst case scenario, I don't want to lose more than $1,000 on any trade, but especially the high probability trades. So if that's the case, then I'm going to cut that in half for this trade, because this is a speculative trade that has an earnings announcement before expiration. So I'm going to cut that in half, again, at the worst case scenario. Most likely, I'll cut my losses in half. On any kind of directional trade, I kind of cut my losses in half of their worst case scenario, even if it's a long put. But you can see the reward potential if we get down to 105 and stay down there is at almost $1,000 of reward. So there's some good opportunity to the downside if we make a run towards this 105 area, which again is the bottom end of this range that we've been in. If we go below that towards 100, then you can see why that would be a really good, for the risk that we're taking on this trade, which is marginal. That's and 4-to-1 reward to risk ratio is a decent trade opportunity for a stock that we're speculating, right, that this resistance is going to hold and we're going to make a run back to the downside. All right, so that does it for today. You've heard from me. Now I want to hear from you. Use that link right there, popping out in the top right corner of your screen. Takes you to our Market Outlook forums on marketscholars.com. If you have any questions or comments for me on today's video, let me know in the forums there. Be able to continue the conversation with other market scholars that watch these videos. Make sure you also reply to anybody else's thread that they may have started with what you know and your experience and what you may be seeing. As always, thank you very much for watching our video tonight. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video. Follow me on Twitter for more content in between the videos, and join our community at marketscholars.com, as well as the one that we created on Facebook for Market Outlook viewers. So again, thanks everybody. Have a great rest of your evening, and we'll see you all next time.